What's up, traders? Welcome to the Day Trading Show. Today, we sit down with the legend Brian Shannon. Brian, some of you know him as Alpha Trends, is the father of the anchored VWAP. We talk a lot about his process, a little bit about his upbringing, his mindset, his beliefs. You guys are going to like that. We also do some screen share. So make sure you're watching on Spotify or YouTube so you can actually see the charts that Brian shows us. It's incredibly simple and effective what he teaches and talks about. So I think everyone, no matter how you trade, you're going to enjoy this episode. The only other thing I want to let you know is we have a 3-day free trial to ASFX TV linked in the description to this video wherever you're watching. So if you want to come watch me trade live, Tom, our whole team of funded full-time traders, hit the link, take the free trial, and come check us out. Now, enjoy the episode with Brian Shannon. Welcome back, everybody. We have a very special guest in the building. Tom, my co-host, and I are sitting down with Brian Shannon. Now, Brian does not need this introduction, but I am going to tell you guys a little bit about Brian's experience. So Brian currently lives in Colorado, here in the States. He has, Brian, how many years is it now? Can we say 30 years of trading experience?
Yeah, I mean, 1991, really full time. And yeah.
Yeah, so 30 years of experience. First job was, correct me if I'm wrong, a penny stock company. Thomas
Yeah,
James.
I was a broker at Thomas James, which was basically a bucket shop, penny broker. They're not the best firm out there.
What a time to be alive. So when you watch Wolf of Wall Street, do you think back to that and can you remember, oh, there were companies like that were in strip malls that were doing that around that time?
Yeah, I mean, that's kind of what this firm was. And a
Yeah.
lot of the lines in that movie really, I used to say those lines. It was crazy. It was really familiar. Fortunately, I didn't stay with them very long. I was there actually about 2.5, 3 months. Then I moved over to Lehman Brothers because it was obviously at the time a respected firm, and they taught me how to sell,
That's awesome.
which was what the
Lehman.
job was.
Exactly. Are you familiar with Ron Friedman?
Who?
Ron Friedman. He goes by Ron Shero. He works with Sanlucci and the options guys over there. He
Oh,
was he was brought up as a market maker, and I had him on the podcast. I'll introduce you to because you guys are
okay.
similar experience, similar age. He has a ton of experience, great guy, really nice guy. And he said the same thing. He's like, when I started as a broker, I was just a salesman. It's not like I had to know
Yeah,
anything about technical analysis. I just was a
not at
salesman.
all.
So same upbringing for you. And then from there, you bounced between a couple of different firms, but you really, I think you did most of your tenure. Was it like 2000 to 2006 with MarketWise? Is that correct?
I was with them as, yeah, not as a broker, but I was doing, technical analysis training. And then I did so I had courses there to teach people trading.
And what was that
And
like through the dot-com bubble and then after that, right?
yeah, exactly. So it kind of just put structure to it. The person that I was working with, David Nasser, had a great reputation at the time, wrote a best-selling New York Times best-selling book about trading. And then, he had me head up the education, and then I headed up the proprietary trading department when that was brought in. So I was trading the funds and also managing a desk of traders as well.
That's awesome. And then 2008 is when the first book was written, correct?
Yes, so MarketWise kind of folded up in about 2006 or seven, I believe, and it's so long ago I don't even remember. And during that time, so speaking of Dave's book, it became a New York Times best-selling book, and I thought, there's nothing special about this book. It's a good book. I mean, and truthfully, it is better than what I was giving it credit for at the time because I was cocky and young, and I was thinking, well, I could do better, and but I didn't. So I always thought, I could write a book, and it took a long time to really do it. But yeah, that was technical analysis using multiple time frames was put out in 2008.
Yep. And that was I think a big landmark piece for you. Now we have the new book out in 2023. Got to
Yes.
flash this nice here. I love the quality of this book. Now, to kind of branch off from our intro, I have to give you a lot of credit and a lot of flowers for that because there's so many trading books that are not detailed in terms of the quality of the pages. They're just words on a page. Not only do you have charts in here, you have colored charts and you have font that is very small but still legible and fine printed well. It's a very well put together book.
Thank you. I mean, so I had control of that, and that's part of the reason I didn't go with a traditional publisher. A traditional publisher would have probably made it, a little 5x7 little
Exactly.
notebook with black and white charts and mass produced. And this way I had editorial control of every piece of the process along the way.
Oh yeah, you can tell. And I think from a trader's perspective, like if I pick up a trading book, specifically one that's going to talk to me about strategy, I want to see it. I need to see pictures. I need to see this thing
Right.
and really feel it. So beautiful. So there's a little intro for everybody that doesn't know Brian. Now, Brian, I need you to take us back here. 13-year-old Brian, what were you like? I'm curious.
I was super shy, quiet kid. I was a really, I was into sports a lot. I was a really good swimmer, and that's really kind of gave me confidence early on. I wasn't a very serious student. In fact, I was just generally, doing enough to get by. I was smart, but I didn't apply myself. I used to get into trouble for that over and over again. Probably had ADHD. So I did get an interest in the stock market just by, hanging out with my dad watching Wall Street Week on Friday nights. And that kind of led to my first foray into the market was actually when I was 15 years old.
What was your first trade? Do you remember?
Yeah, of course. It was LoJack. LoJack is yeah, I think we know pretty much most people know them today. They started out in the Boston area tracking stolen cars. At the time, Boston was known as the car theft capital of the world.
Really?
And
Wow.
yeah, and they so LoJack donated some of these trackers to the Boston Police Department. And so then they started going into cars. I remember it was like $500 per car to track it. And I said to my dad, I said, that seems like a pretty interesting thing. Can we buy stock in it? So I used to do paper. That's the other thing. I was kind of a little entrepreneur as a kid. I would, sell gum in school, and I would, rake leaves and mow lawns and deliver newspapers and caddy golf, and just I was a little hustler, I guess. So I had some money saved up, and he said, sure, the stock's $5 a share. Uh, you've got your $500, put that up and we'll buy 1,000 shares. I'll basically give you the rest of the month, $4,500. So I didn't realize at the time, but I had 10-to-1 leverage, right? Or 9-to-1 leverage. I didn't even think of it at all. I had no concept of risk. And, so we bought this 1,000 shares of this stock at $5, probably paid a $280 commission or something crazy like that.
Crazy.
Yeah, and then within about 3 months, I think it was, the stock went to $10 a share.
Double
Wow.
your
And I
money.
said to my dad, I said, let's sell this. He's like, okay, sure. So it was a double. It was more than a double for me. It was a double on the full principal. But he lent me the money, he got his $4,500 back, and I was left with 50, basically 5,000, $250 round turn. But I made $5,000, and here I am 15 years old thinking, why am I working so hard doing all this other stuff? And, it's a good thing I really don't pay attention at school, because I don't think I need it, because I'm just going to trade. This is so easy.
I love it. I love it. And I feel like there's so many traders that are going to be listening to this that can relate to that type of an upbringing, the hustler. I mean, Tom and I, we've talked about it many times. Same thing. Lemonade stands, shoveling
Yeah.
snow, like you name it. We've all been there. That's
Mom's
the
jewelry.
hustler. Right. Mother's jewelry. Yep. You name it. I've tried to sell it. Come on. Like that's whatever it takes. So now the reason I asked that question, Brian, is because I want you to speak, if you can, for a second, to the 13, 14, 15-year-old kids now. You're aware with the prop firms nowadays, the funding companies, the education that's available. It's just a different landscape. So for kids now that are going to be listening to this, because, I post this on TikTok and everything like that, what would you say to them if they're interested in finance? What would be some advice you could give to the younger guys?
I would say, learn what they teach in school, but also learn the stuff that's going to actually help you make money. I don't mean to be negative about education, because it's obviously so important. I was just talking to my wife about this last night, saying, I think that education is going to have a chance to become better, because now that everyone has access to all the information at our fingertips with AI, and it puts it together, that, hopefully schools are going to start to, focus on more life skills, how to communicate, how to sell, how to manage your money in the market, and how to communicate with people. That's a basic skill that that isn't taught. So everyone learns a little bit differently, but with the way that we can access all this stuff, especially look at the YouTube videos, and the most difficult thing for that age group, and anyone in particular, is it's not always just about who gets the most clicks. You'll see a video. I'll look at a video, that has 250,000 views, And I look at it and go, this is complete garbage. It's
Right. It's
junk.
wrong.
It's
It's like
bad.
actually wrong information.
Yeah,
Yeah.
exactly. And I look at VWAP videos because that's my thing, right? And
Right.
I'm looking at, this guy obviously read my book and he gets some of the concepts, but he's just making stuff up that's not how it works. So you know, find a mentor would really be the best advice. If you can find someone who's going to give you some attention individually or just, in passing on Twitter or whatever, reach out, ask questions. That's what I would say. That people are accessible. I respond to, 95% of all the texts that people get, do on Twitter and that sort of thing. They're not tech savvy, but anyways, people are generous with their time more so than you realize, and be proactive. I was just a quick story.
Yeah.
A couple of years ago, I was at the CMT event, and someone came up to me and never met him before. He said, "Brian, I know your work. I like what you do. Will you be my mentor?" I was like, "Fuck, that's awesome! Of course, yeah, great, yeah, I'd love to be your mentor. Thanks for asking. That takes some balls, to ask." What's going to happen? It's like asking out a girl. You have a
Yeah.
crush on the girl, go ask her out. Just, be proactive in life.
Yes, I love that. Tom, do you
Agree.
want to touch on that for a second about the coachability? We were just talking about this in our staff meeting this morning.
Yeah, we were. We were talking about one of the traders on Twitter, funnily enough, posted that one of the things he looks for when hiring new traders is the ability to be able to be coachable, because I think that's one of the skills as traders that we have to be. So yeah, he was talking about that. That's one of the probably the most necessary skill in trying to hire traders at firms, etc. What do you think the best skill that you've got is, or that you would advise these 13, 14, 15-year-olds to take into their new careers if they're looking to get involved?
Well, intellectual curiosity, and again, if you find a mentor, being able to listen. At that age, I love the Mark Twain quote. When I was 15 years old, my dad knew nothing because I had all the answers. But then when I got to be 30, I realized, I knew nothing, and my
Yeah.
dad was pretty smart. So listen to people with experience, successful people. It's, you go to the gym and you hire a trainer. You're not going to hire the overweight trainer. You're going to look at him and say, "Hey, that guy's fit. I want to do what he's doing. I want to be like that." So, be coachable, but choose your coaches wisely as well.
Very well said, which is
Great advice.
to like the point you made about education. I have a son on the way next month, and like we're thinking about school and everything, and it's like being an entrepreneur, I don't know if I want my son or daughter in the future to learn from someone who doesn't have the proven skills in a field in almost anything at all. They're just regurgitating
Right.
information out of a book. Wouldn't it make more sense to go and actually get hands-on experience from someone who has what you want, or at least what you think you want? I remember once when I was like in college, my dad told me, he was like, just try things. Like, go to the career fair, get an intern. That's how I stumbled across day trading. I was at a career fair internship thing in college, and I ran into the Northwestern Mutual guys, and they got me into that finance path. And that's where I started studying for my Series 7 and how I stumbled to this point. So it's like being, like you said, intellectually curious is, I think, a great characteristic for young people. And like Tom said, to be coachable as well. Both really, really great points. Now, when you think about everything you see today, Brian, on the internet with Twitter and FinTwit, finding a mentor is sometimes more difficult because there are people who act like they know what they're talking about. Like you said, they just speak with confidence, right? What are some of the telltale signs of a real trader? Let me just give you one really quick. I saw this company, who does not need to be named, advertising their trading education as "we don't take losses." And that really got under my skin, because that's one of those things to me, like that we mentioned already, where it's just wrong information. So when I hear
Most
someone say
important
"we don't
skill
take
you can,
loss,"
yeah,
I'm
yeah.
sorry, go ahead.
It's the most important skill you can have, is to be able to recognize a mistake and take your loss. That's
That's
learn
huge.
from those guys.
Exactly. So what would be some of those other characteristics that you would say really are conducive to good trading? Being a good loser, definitely up there. What else sticks out to you?
Again, having an open mind to learning new things, being able to take profits as well is something that you need to have the ability to. Recognize that you can't just buy and hold the market. The winners don't take care of themselves. You have to be able to take some profits along the way, and try to remove your ego as much as possible and listen to the market. So some things to look for. I think what I'd like to do, I can say, is that differentiates me from a lot of people, and even some well-respected people, is people who manage risk and mention risk, every single time I talk about a trade on Twitter or a setup, I say, here's where a stop would go. It's never, because you look at people who say, hey, I mentioned this stock at 20 and then it went down to 17 and now they're talking about it when it's 27. And it's like, wait a minute, it dropped 15%. Are you trying to imply you held during that 15% decline and now you have this large gain to talk about? So it's the people who make it look easy are liars, because it's not. It's a very difficult endeavor, trading successfully. So be realistic.
Be realistic, speak on risk first. I think realistic expectations is something we've found, like, throughout doing this podcast. We've talked to traders like yourself who have decades of experience, but also some of the younger guys who are year 1 or 2 that are in our coaching program, and we bring them on because we think they can share value. They all say, I wasted time at the beginning with unrealistic expectations, like just thinking I'm going to make 50% a month every month, and that ends up holding them back in the long run.
Right.
Yeah. Well said. Well said. All right. So let's get into some of this anchored VWAP stuff. So one of the big chapters in the book, and I have a couple of questions here, so we are going to bounce a little bit, but for sake of time and for the listeners, I think we'll still pull value from this. The pinch, Brian, this is one of the main chapters that really stuck out to me that I've now been using, Tom will tell you, in my analysis, just more and more, especially on the higher time frames. So one of the things you mentioned is that not all pinches will be solved in the direction of primary trend. Can you elaborate on that a little bit more?
Sure. So a pinch, just to describe it for the audience.
Yeah, that's a good idea. Please.
Is basically, you have 2 volume weighted average price anchors, and it tells us the average price from the beginning of that point. So you might have from a significant low 3 months ago, and then the stock ran up and it made a high a month ago. So we anchor a VWAP that kind of comes up under prices, and then off the top it comes down, and then prices compress between there. So when they compress between there, what we, in technical analysis and trading, we consider a trend once established is more likely to continue than reverse. The problem where people get into trouble with that is which trend, because there's multiple trends that can be present. So we assign that to the larger time frame trend. So in this case, the 3-month trend, as it pinches between there, it undergoes some profit taking, and the prices tend to consolidate between those 2 volume weighted average price levels, and they compress in between. And what we would expect is that once it breaks free of that range, that it would continue to move higher. So that's what we're looking for. That's our thesis, just generally speaking, based on price behavior. Then we want to, of course, buy when the momentum begins again, but then set our stop, because, they can fail. So I was sure to put a number of examples in the book where, here's one that looks like it's, perfect setup, but then it goes on and fails. So how do you, how do you avoid that? Well, one, you don't avoid it. You don't buy while it's in the pinch. You wait for it to break free of that range, and then you set your stop. If it breaks to the downside, big deal. Who cares? It's just, it didn't work, and that's life. And the good news is it failed before you got in. So the market did you a favor, because it's not like it broke out, you got involved, and then it reversed. Instead, and I see it all the time, lately, especially, there's been all kinds of, stocks that look like they're ready to break out. They make a move for a day or two, and then they just get the snot kicked out of them.
Do you think that's macro conditions we're living through right now, like the uncertainty, and that's why you're not seeing the follow through?
Yeah, definitely. I mean, the market is still uncertain. It's not really in a strong downtrend, and it's not in a strong uptrend. We're in maybe that stage 1 accumulation. My thesis for the beginning of this year was, if they didn't scare you out in 2022, they will most likely wear you out in 2023.
They'll chop you out. Yeah. I remember, I think you tweeted that or something. I remember seeing that.
Yeah. And it's, I mean, because it's true, it's part of the bottoming process that, we have, supply and demand changing all the time, but there's still large institutions with big positions left over that they're trying to get rid of. And then there's new institutions saying, hey, I like that stock, I'm going to start building a position. So it's just really a big battle zone. And in that battleground, there's a lot of chop, a lot of false moves that people fall for. We can, there's stocks that are still in horrific downtrends that have doubled and tripled 2 to 3 times on the way down, but they're still, down 90% overall and close to 52-week lows.
Does that remind you of the 2001 tech bubble?
It does, yes, yeah, because at that time it was the same thing. It was, over the end of the upside. We got, we pulled back hard, and then it was a period of, it wasn't the same stocks leading the way. Cisco was the biggest company that people were in love with, and we still have not eclipsed the 2001 highs in Cisco. Now,
Really?
Microsoft has done much better. Intel has kind of been, flattish. But those were the leaders of the day. So it's not going to be the same stocks from 2020 and 2021 that, had these massive runs. They're going to continue to move higher. It's not going to be Zoom. It's not going to be Peloton. I can say those with confidence.
Yeah, that makes sense. I mean, look at what was happening during 2020. Why those two stocks in particular? Why would they do well? Well, we were all locked at home, so it makes sense. Do you see this shifting sectors? Like, do you think the next bull run will be led by a different sector than tech?
No, I don't. I think there's always just going to be that's where we are in society. Is everything's
Technology is the
technical.
forefront. Yeah.
Yeah, it might be a different area of tech,
AI
but
instead of whatever.
yeah, but the one thing in common is that they all have semiconductors at their core. AI does, the cars do, whatever the new device is, they all have chips. So I think that chips are the main commodity that will lead, when they, and in this year that's been the case. They've been the biggest winners this year is the semiconductors.
Yeah.
So it's kind of the same leadership in that regard, because what goes into every tech is semiconductors. So if they're rallying, it might be not a stationary bicycle or video conferencing, but it might be, hey, we're processing, Bitcoin mining machines, and we're processing these mega computers that are learning AI and all the different applications that come from that.
Yeah. Do you feel like the companies now, like Apple, that are at the front of this, that and Google, that might get that technology, do you think they could ever be superseded when it comes to technology? Like, because if you look at the dot-com bubble, like you said, Cisco was the big dog, then everything crashes, and now it's not the big dog. Are these companies too big to ever be dethroned, or is there an American company that's going to start making semiconductors, and next thing you know, it's going to be second biggest company in the stock market?
I think that's possible. I think
Okay.
we're kind of veering a little bit from what I normally talk about as well, and I don't mind talking about it. The point
Sure.
is, though, that I might express these opinions, but when I go look at my chart and I look to place a trade, that goes way to the back of my head and almost has zero impact on the current trade I'm taking today for my time frame, which is a swing trade, or
Sure.
2 to 8, 10 days maybe. Those are just, that's kind of interesting cocktail hour talk, but
Exactly.
it's not gonna, the market doesn't care about my opinion. I know that. I'm not that smart. I don't read enough about it, basically because it doesn't help me make money. And I'm interested in more in what's going to help me make money. And it's what I see unfolding on the charts and the supply and demand.
That's well said. Do you find one sector or one group of stocks that performs better in a back test with the anchored VWAP? If you were just to look for bounces in a bull market, are there certain sectors where the VWAP works better?
I am not a back tester, so I'm a stock picker, and I'm a live money trader. I think there's nothing wrong with back testing. The problem with back testing, for instance, with the anchored VWAP, is one of the biggest problems with that is the subjectivity of where you anchor. Now there's you can find you can make some rules around it. You can say, well, year to date, or from the 26-week low, the 26-week high, and test for things in there. But to me, it comes down to everything I do is based on multiple time frames. So I might look at a daily idea, but and it's bouncing from that volume weighted average price, but I'm not involved yet because it hasn't confirmed on the shorter term time frame. So I think that there's nothing wrong with looking for those types of plays to give you that edge. To me, it's kind of like seasonality. We talk about seasonality in the market, and that's interesting tidbit, but it's not a reason to take a trade. People always say, 8 out of 12 times during an election year, this happened or that happened. And they hang their hat on those 8 times, but they forget, well, 4 times, 1 out of 3 times, the market might have got crushed. And so it's all about, finding the opportunity in front of you right now and then boiling it down to, can I manage risk effectively in this trade where I think I might have an edge because the seasonality lines up, because it's based on some kind of crop, and we have an election year, and the semiconductors typically do this in February, or whatever it might be. Those are all just very minor roles to price, because only price pays.
I love that. There's our first one-liner, only price pays. Did you have something you wanted to throw in there, Tom?
Yeah, so I was listening to a podcast yesterday about the amount of combination. So you're talking about like none of that factors into your process when you're taking a trade. So I am going to ask you a question after this about what your process looks like when you take a trade and how you come to that decision. But I was listening to another podcast about people pricing in all of them fundamentals and the variables that go into this and things like that, talking about how algorithms can't sort of like take over, because like in a closed game of cards or a closed game of chess between two people where there are only a finite amount of moves, for two players playing, the first 4 moves has a combination of something like 28 million different moves with 4 different moves, 2 in each side. So if you're trying to price in all of these variables in a market, there's almost infinite things to factor in. It's almost impossible. So you can't ever do it like that. So when you're talking about like the price and VWAP, what does that process look for you when you're sitting at the desk or you come to at the start of the day? How are you like filtering that down to say, this is how I'm going to take a trade?
Yeah, great question. So, there are all kinds of different things to look at, and you can make infinite combinations of that. So we have to say, well, what are the most important things in the market? One is price, because again, only price pays. Volume gives us the ability to kind of measure the emotional commitment and see surges in sentiment. And then what's our time frame? What's the time? So price, volume, and time are the 3 most important factors, and that's what comprises of the volume weighted average price. So it gives us 100% objective way of looking at the market. So when it comes to me looking at setting up a trade, it starts out with me first with stock selection. And how do I select my stocks? I start by going through what I call my master list, and I go through those manually. And it's more work to do it manually, but at the same time, it's not, because I've been doing it so long, I can go through a lot of stocks quickly. But when I look at my stocks, I look at 6 different time frames. I have a weekly time frame, a daily, a 65, 30, 10, and a 5-minute time frame. Now, my focus tends to be the daily and the 30, because they're kind of stacked on top of each other. That's just the center of my vision. And that's for a reason, though. I made it that way. The daily gives me the general trend. If I can't really see that trend, or if it's at new highs, I'll glance up at my weekly chart to see what the bigger picture might be. Maybe we're running into a source of supply from 3 years ago that might halt it straight in its track. If not, then I kind of go down to that 30-minute time frame and say, okay, where have we come from? If we've just rallied 10% in the last 3 days, I'm generally not interested in it, because what more can we expect from a stock? And that's a mistake I see a lot of people making. Hey, Brian, what do you think about this stock? And they'll show me a stock. It's always up 10 to 15% in the last 3 days. Successful speculation is about anticipation. So we want to anticipate. We want to see the stock is in an uptrend on a daily time frame. It's pulled back on a shorter term time frame, and I don't want to buy the dip. I don't want to buy the pullback, because maybe it's one of these ones that just keeps pulling back and completely fails. So instead, I look at it and say, and again, I don't want to buy it on a breakout past the high from 2 weeks ago after it's gone 10%. So instead, I want to watch that pullback kind of settle in, go sideways for a day and a half, 2 days. And as it starts to show some momentum on that shorter term time frame, then I switch over to my 10-minute time frame, and I kind of come up with my risk reward. And then I look at my 2-minute time frame, at the beginning of the day, and that's where I set my timing. And that's where I say, okay, now's the time to buy the stock. I'm going to set my stop under here if it fails. And if it goes, I'm going to continue to hold it as long as it makes higher highs and higher lows on my time frame, because I'm trading for a trend. So I've raised my stop underneath those higher lows. If one of those higher lows is broken, then it's time for me to get out.
So I love that. And when you said at the start of the thing, you're looking to like swing trade between like 2 to 8 days, ideally, something in and around there. When you're down on the 2 minute, are you then going back up to the higher time frame to trail that stop so you can hold it for multiple days? Because obviously that on the 2 minute time, you're going to get them pullbacks where highs or lows are taken out. So do you then go back up and manage it on a larger time frame again?
Exactly. So the short-term time frame is really just to fine-tune that entry. After that, I really don't pay too much attention to it. So I'll use that, for instance, going back to the question of how does the VWAP tie into this. So when I see that momentum starting to begin on that 10-minute time frame, what often happens is it's the prior high, I anchor a VWAP to that stock gets stuck under it and it breaks up above that volume weighted average price. It tells me with 100% certainty, now I know that the average buyer from the highest point where that anchor was is now in a winning position. The average short seller is in a losing position. So I know with certainty the buyers are back in control. So that's where I want to participate. And then I want to look at, to say, well, I don't want to chase the stock. Let's say it gapped up from 24 to 24.80 that morning. Well, I don't want to chase that gap. So if it pulls back to 24.60, I'm not going to buy the pullback. If it pulls back to 26.50, I'm not going to buy the pullback. But the daily VWAP is going to come down on it. Then maybe it starts to stabilize at 25.50, and then it breaks above the daily VWAP. Well, at that point, at 25.52 is where I buy the stock, because I know that the initial profit taking is hopefully done, and the average buyer who chased the stock higher is now making money. The average short who's short, tried to fade the stock, is now losing money. So now the buyers are back in control. It confirms what I've seen on the 10-minute time frame, the 30-minute time frame, the daily, maybe even the weekly time frame. So the entry is on the very short-term time frame, and then I look to my longer, to the 10-minute time frame, and say, what's the most recent relevant higher low? Because if it breaks below that, my definition of this emerging trend no longer exists. I've got to get out of this trade right here, right now.
No, that's a very well explained process. 2 questions to follow up with. Do you favor specific stocks, large cap stocks, small cap stocks? And then beyond that, do you notice that maybe the small caps with more volatility, they bounce a little bit weirder around the VWAP, and the bigger stocks respect the VWAP better because of institutions involved?
Yeah, I mean, I think there's something to be said for that, Austin. It's I don't trade a lot of the little ones, like I'm too old for that. I used to do that 20, 30 years ago. But I'm also not trading IBM. So for me, my sweet spot tends to be more kind of like mid cap type stocks. And if you take a look at the Russell, it's garbage. So a lot of those have been failing. But based on market conditions is what I favor. I favor whatever is kind of just set up nice and clean. It's a process of elimination for a lot of things. I want to get rid of the stocks that, people say, hey, Brian, this stock doesn't make sense to me. Will you take a look at it? And 9 times out of 10, the answer is, well, it doesn't make sense. It's telling you a very clear message. Leave it alone. There's no reason to trade Tesla today. Just because it's a popular name doesn't mean you have to trade it. If you don't see it, well, why would you? If you don't feel you have an edge, then the message is clear. Just stay away.
When you don't align with your gut, stay out. If your gut doesn't feel right about it, and then you get into a position, you're going to feel even more stupid when you take that loss.
Yeah. So, and a lot of times my gut will help me in that way. And I'll say, I'm not sure about this one. It's set up so nicely, but I'm not sure. So to me, if it's got the criteria I'm looking for in terms of the technical setup, but just something feels off, I'll generally still take the trade. but I'll do it in a much smaller capacity. I won't, put on my full risk unit. Then it comes down to the art of position sizing, because a lot of people try to make that a science, and it's all an art. We talk about our risk unit, and we've got to adjust that risk unit because risk isn't always the same. We've got, do you keep things, do you manage risk the same on the day that the Federal Reserve is announcing or a jobs report?
Right.
No, that's just foolish. Or on the day that this company is due to report earnings, are you going to put on your full risk unit and hold it through the close? That doesn't make any sense.
It does if you want to gamble.
Have you always sort of been like that?
Yeah, right, but we're talking about professional trading.
Yeah, we're being professional today. We're not gambling.
Yeah, no, no, it's a great point, Austin, because I'm sure there's some people, there's 13 and 15-year-olds that maybe, or even adults do this. They want to take a shot based on their gut. And I just had a conversation with a subscriber at Alpha Trends who did that just recently with Mobileye. And he knew the earnings were coming out. He kind of forgot, but Mobileye, it was a great setup. It looked awesome on the chart, but earnings were due out. And I said, listen, it looks great. I'm not getting involved, not going to do it. He did hold it, and now he's beating himself up. And it's a kind of a sad story because he's a guy who cares a lot. He's, works hard. He's got what it takes to be a trader, but this isn't the first time he's done it. And now he's wondering, should I continue to be a trader? And I was like, slow down. Yes, you should continue. Just take some time off. But don't, so I didn't mean to rail on that in particular, Austin, but.
No, it's a great point. I mean, because I was being half serious when I said it, because there are everyday guys that want to take that shot. Like you said, that the ego, the confidence comes out, and it's like, you know what? I've really been studying this thing. I know Cisco's going to finally break through for a new all-time high this next earnings cycle. I'm going to run it on this one. And then overconfidence comes in, little confirmation bias sprinkled in there. You start searching for information. You only find things that back that they're going to crush earnings. And you're like, yes, this is finally the time to hold through earnings. And then that's the time it's going to smoke you. I'm assuming he got smoked, right?
He did, and he's a great guy, and I hate to see people do that. People seem to have short memories, because 2022 was the year that should have taught people, don't buy dips, don't do these YOLO trades. It's stupid.
Right.
I don't know what the numbers are, but Robinhood accounts, how many of those accounts have closed and gone on, and they've given up on the market until they can build up their nest egg again and either repeat the same mistakes because they give in to greed, or finally learn there's a process and it's not get rich quick. There are some good quick trades you can take, but have a disciplined process is what it comes down to.
Yeah, and 2020 set the standard for that, I think, in the wrong ways.
Yeah.
You know what I mean? It got everybody sucked in thinking that you could buy any dip, or really just buy anything at any time and make money.
Yeah.
I think a lot of people focus on what they can win rather than what they can lose.
Yes.
A lot of the time. I think that's the biggest one for me. They see these things and they think, oh, I can make it on this one, but they never think what they can lose.
That's it.
And again, that goes back to what Austin was saying at the beginning. What advice would you have to sift through what these people on YouTube are saying? If they talk about risk management, give those people an honest look. Try to figure out what they're doing. But if they're flashing their fancy car and that they're, this big watch and they're on vacation here and there, and they just talk about these big winners, it's a red sign, stay away from those.
Yeah. You know what I noticed too? I never know how much size exactly the biggest traders, like the guys I look up to, like yourself, Brian, like even how you describe your position size, a unit, your risk size in your head is a unit, whether that be however many lots or however many, units of the shares of the stock you buy. I find that like the biggest traders, the guys who are, they never talk about it. They talk about percentages in loss and in gain. That's always the focus, but never, I made 50 grand today or 100. It's just not often the topic that comes out first. Would you agree with that?
I never talk about my P&L. I talk about a trade and I got stopped out of some here or I took some off there, but one, it's my money. It's no one's business, right? I mean, I don't know how people are so comfortable talking about their money. The way I grew up is, money's a private thing. You don't talk about it.
Me too, bro. I don't understand it.
And, they show those big gains one every 20 days. They don't tell you what happened the other 19 days. If you're going to show your profits, you have to do it every day. You have to show your losses as well, is the way I look at it. And, it's just what good does it do? If you're trading big size and you're making big money, it's just going to make other people feel badly about themselves.
100%.
It's more about, hey, here's a process. If you bought 25 shares or you bought 25,000, the opportunity was there to make this much. You can grow to whatever level you want or whatever level you're capable of financially. And it's really no one's business.
No, and nowadays too, you know, it got me thinking about this. We are international with the internet. You have people who don't need to make 50 grand a month to live a good life. Like in New York now, what do they say? You make 100 grand, it's like 30 grand. Okay.
Yeah,
But what about in Santo Domingo? How much money do you need to live in the Dominican, right? Like a lot less.
not
So
less.
yeah, so I think that it's very well said. Very well said. All right, I have one more question about VWAP, and then I'd like to do a quick screen share and go over some charts.
Yeah.
Talk about the three different points really to anchor the VWAP from being price-based events, time-based events, and then the fundamental events. Could you give the audience just some clarity for the people that haven't read the book, why you chose to group it into those three types of places to look for an anchor?
Yeah, it all comes down to what are institutions doing? How do the institutions, execute their orders? The VWAP itself was invented in 1988 as an order execution benchmark for to say to a big institution saying, hey, how well did I, the stock was, had a low of 24 today, high of 26. I had my broker buy me 500,000 shares and he said I got 25. Well, that's in the middle, so I guess it's good. But the average price the stock might have traded at was $24.20. Well, 25 isn't looking so good anymore. Or if you got it at 25 and the stock, the average price was 25.75, you did a great job, and that broker wants to brag about it and say, hey, listen, look how well I did for you. Well, so that's how institutional orders are, executed throughout the day. I won't go into the mechanics of it because that'll just take a little bit too long. But they're based on, how the stock typically trades, where the average volume is during the day. What the volume weighted average price is called the price a naive trader could expect to get, because it's where the average price based on the volume traded at. So if you're just being average, you can get that price. Well, institutions will, over the weekend, their committees will form. They'll say, this week we need to buy 2 million shares of this stock that just reported earnings. So we're going to buy 2 million shares this week. We're not just going to go in with a market order Monday morning, because that's going to cause the price to go up 50%. So they want to be sneaky about it. They want to reduce their market impact cost. They also want their market impact cost where so they can buy a little bit at a time and it won't drive the price higher. They also want to hide their size. They don't want to bid for 2 million shares. Then everyone sees this bid for 2 million shares at 25. Well, I'll take the offer at 25.05.
Yeah.
This knucklehead's going to go chase it, So they've got to, incrementally buy, and they do that based on the U-shaped volume throughout the week and each day. So they might say Monday does 25% of the average volume during the week, and Wednesday does 15%. So if we're buying 1 million shares, we're going to buy 250,000 shares on Monday and 150,000 shares on Wednesday, because we don't want to cause disruptions in the market. Well, how does that 250,000 shares trade on Monday typically? If it trades typically, 5% of its 10% of its volume in the first 5 minutes, what they're going to do is they're going to buy 25,000 shares in the first 10 minutes. So they're going to participate in the average volume. So they're not moving the volume around and chasing and causing a disruption in the market. So they do that on weekly events. They do it on monthly. They actually even do it on year to date. And there's more reasons in the book about why the year to date in particular is important. So that's time. So from daily, weekly, monthly, yearly, and then so price base. So we're talking about the significant high that occurred 3 weeks ago, or a low. There was a lot of volume. If a stock made a high 3 weeks ago and it's pulled back since then, well, we want to know how's the average participant positioned from that point. The sellers are in control as long as it's below that volume weighted average price. As it starts to battle with that volume weighted average price off the high, it shows us the buyers are regaining control. And as it gets back above that volume weighted average price, we know with 100% certainty that the average price from that high 3 weeks ago is lower than where the stock is now, meaning the buyers are in control. And we see the same thing, of course, on the flip side. So that's price based. That price base also occurs around fundamental events. So earnings reports are one of the best. We'll talk in a minute about the Federal Reserve. So from an event, something that shakes up the volatility in the market, that goes in there and people readjust their thinking about what the market is going to do or that particular stock. What was a catalyst that really got typically a lot of volume, emotion, and just a rapid revaluation of the stock. So those are, again, that's, as you said, time-based, price-based, and fundamental events. Whether it's an FDA report, a Federal Reserve meeting, earnings report, whatever it is, if it causes a disruption to the market, you want to measure the true supply and demand from that event.
Makes sense.
Very well explained. Last follow-up on that before we do some screen share.
Yeah.
Do you favor start of the month, year to date, or start of the week? Could you rank, like, is there anyone that's, if I had to have one VWAP only, would one of those three be better? Start of the week, start of the month, or year to date?
I think probably just for my time frame, the week would be the one,
because you want to see the breadth of it throughout the week. Do we break on Monday? Maybe we're pulling back now on Wednesday, kind of thing, and then we can get a price
exactly.
hold that.
Yes.
Okay.
But I would also say that time based takes secondary to highs and lows, and maybe even fundamentally driven, because that there's a reason. There's not, everyone always wants to know why is that stock doing this or that. And most of the time, the reporters just make something up, or they repeat a rumor that someone told them so they can get their piece out by their deadline in 10 minutes.
Right.
That's, so it's really more about the supply and demand from an event. That really, especially now that we're in earnings season, that is one of the best times to really pay attention to those event based.
So because you're not bothered what moved the market, you'll just want to know where and when it came from that event, which is what the anchored bit of the VWAP does, because it allows you to place it exactly where that event started from.
Yes.
Yeah.
But you don't care what caused it.
No, I don't care, but there's a little bit in the piece in my mind that says, at the end of the day, stocks trade based on earnings. Even if they don't have earnings, it's expectations of earnings down the road when this Bitcoin company creates this, or this AI company is profitable and has this sold to that. So if I know that there's a good looking chart, I'm trading the supply and demand. I'm trading, hey, it's in an uptrend. That's typically going to attract buyers, so I want to be interested in it. That's the psychology of the price action. But I also want to be aware of the psychology of the fundamentals. I don't want to say, I think the earnings are good and this is a great company, because the market doesn't care, and I might be wrong about that. But what I do want to know is, what does the crowd think about this, and how is the crowd behaving since that event? Because now I know if the stock gaps up on earnings, pulls back for 3 days, and then gets back above the VWAP, I know why they're buying to a degree, because there's so many fundamentally driven funds out there that buy because of fundamentals. So if I can say, now I know there's likely to be a good source of demand from the fundamental crowd who, runs this growth fund and 500 other growth funds like it. These are the types of stocks they have to be buying. I know there's a source of demand that's highly likely to come back into this when it pulls back to that VWAP, and therefore I want to watch the price action carefully. So it's a little bit of all of it combined.
Yeah, definitely. Do you find that most of your trades are bounces off of VWAP, long or short, or do you find that you're normally waiting for that accumulation, the energy builds, it breaks, confirms a break, and you're catching that momentum on that break?
That's what I prefer, Austin, because my preferred time frame is a swing trader, and I like to, that to me, to get involved after that compression of energy and the buyers regain control. It tells me I'm at the beginning of the onset of a shorter term uptrend, which is in alignment with the longer term uptrend, and then I might be able to hold that stock for a couple days, couple weeks. The pullback to a volume weighted average price, or the rally up to a volume weighted average price as resistance, I like those probably secondarily. And I just put one on here a couple minutes ago. So as soon as we want to
Yeah,
So
let's
as
jump into
far
it.
as
You could turn your screen share on. Let's get into it. Do
Yeah,
you
that'd be
find
good.
that
And
is it the bounces are sometimes tougher? Like, because what I've noticed, I've been running it, like I put an anchored VWAP on SPY on the daily from the October lows. And when you look at the bounces off of its lows, it doesn't just hit the line and hold it. It does break under, it does chop it a little bit before then bouncing. So if you don't time it right, you could get stuck with some drawdown or some chop there.
Yeah, absolutely. And the longer the time frame, the more bounce and play there is going to be in it. On the
Sure.
shorter term time frames, it tends to be a little bit more precise.
Which makes sense.
So we use that larger picture and say, now we're in that level of interest, as you mentioned. Now I have to switch to the shorter term time frame to dial in and get my precision.
Got it.
So I just put this on Twitter about an hour ago.
Okay.
And I actually used the NASDAQ futures. It's the same thing basically.
Same
But
thing.
this is the NASDAQ 100, the Qs. And this is the volume weighted average price anchored to the Federal Reserve announcement yesterday at 2 p.m. So right here at 2 p.m., we had that, we had a quiet day doing nothing. The Federal Reserve, we got that big volume, and the stock, the NASDAQ, a lot of bounce around. Later in the afternoon, the sellers took control, and they maintained control right through the close. This is today's volume weighted average price, and it's been pretty damn choppy, right? There's not a lot of value in that one today. But what I was telling, what I mentioned in a video yesterday, and actually this morning on Twitter, is that if it gets up towards the volume weighted average price from the Federal Reserve, I think it's highly likely the sellers are going to defend that level. And so what I did is I didn't, I don't like to short the touch of the volume weighted average price because, as you just mentioned, it might do something along the lines of this, where it kind of gets up through it and then, bounces up to there and then comes down and does this.
Yep.
Well,
Exactly.
I don't want to be short here at 1830 and see it go to 319, because then where do I set my stop? I have no confidence. Now I'm in the position of fear. But instead, if I look at it, this is how I always do it. And this is a 5-minute time frame, so we can go to a 2-minute. And that was yesterday's volume weighted average price. Here's from the Fed right here. So what I look at, and let me just move that out of the way. So you can see it almost perfectly touched it when you look at the shorter term time.
Oh yeah, nailed it. Even on the 5-minute. I mean, you could trade the 5-minute bar that comes off of it and start to trade it down. What's a stop look like that on that for you? Because you have
exactly. If
you have
I
a target below you, right?
there,
Yeah.
what's my stop? I don't know. I mean, is it above this high? Is it above that high? Is it above yesterday's VWAP?
Right.
So, and I put this in the book. I said, here's where, it comes down to personal preference. Sometimes you'll look at that and go, man, I knew I should have shorted it right there. My point is, I like to short it as it drops from there, right from here. That's exactly where I bought the S triple Qs. And my stop was very simple. My stop was right here, just above that little high. So by shorting right here at 317, 98, I think it was.
Yeah.
Shorting right there and buying the S triple Qs. Well, my stop was just above this little peak right here. So my stop, 318.23. If it went to, I always do 2 pennies above. If it went to 318.25, that's enough for me. So now I say, okay, I'm in at this point, not at the exact touch of it,
right?
But as it's bouncing away from it, because then I have this level
to use as a stop
myself.
Yeah.
And it cost me 22 cents, right?
That's crazy.
I missed the peak by 22 cents.
Still, like you don't need the peak. You don't need, you're right. I mean, because look, you're catching majority of this move with a beautiful target at today's VWAP, right?
Yeah. And the reason is because programs got turned on over here, and now they're still turned on to sell when it gets back to that price. So now what I look at it is I say, and I covered some here at the daily volume weighted average price, and it came down here, and I'm still short some. My stop will be right here now. I haven't, set it, but I also put an anchor at this point because that's where the reversal point was. And now look at how that anchor held it back. It broke below, and then, not perfect, but
no, but it's moving resistance. Yeah, it's definitely a great moving resistance. It's almost like the anchored VWAP is a better EMA.
Oh, way better. Right?
Yeah.
And here's why, right? Because we're talking about true supply and demand from an event, not some random time base that people are looking at.
Right.
And you say EMA, I say SMA, but there's no difference really. I mean,
No.
yeah, of course there's a difference, but there's not. The point of, a 50-day moving average or 50 simple or exponential is the reason it, works isn't because it's not a Fibonacci number. It's not the number of days in a quarter, which is 63 between reporting periods for earnings. And there's no significance to it other than everyone uses them on their chart. I've been in rooms. I just did it last week in New York. Said, how many people look at charts? We're at a CMT event, so they all raise their hand. How many of you use price? Everyone like, what's the point? What's this idiot asking?
Right, right. But if you ask them who's using EMAs, everybody's hand goes up, right?
Yeah, so moving averages, 95% of the people use them. And I said, okay, do you use a 50-day moving average? And everyone raised their hand. They're like, is this guy ever going to get to the point? The point is, why do you use that 50-day moving average? Because that's what you were taught.
Yeah.
We were taught that buyers often emerge at a 50-day moving average. So when we look at, for instance, the S&P 500 right now, let me just get rid of, there's a few things going on here, okay? One, this blue line here is the year-to-date anchored volume weighted average price, okay? This red line is the anchor from that March low. This green one is from the February high. So the year-to-date high, this is from the beginning of the year. And this line is the 200-day moving average. And this thin green one is the 50-day moving average. So when we look at this chart and just kind of, isolate some of these things, the other thing is, from this low to that high, this is a 38.2% retracement right here, 50% and 61.8%.
Got it.
So if you think about, when things come together, you'll see that people will be on Twitter today saying, hey, it's pulling back to the 50-day moving average, so I'm going to stop selling. Other people say, hey, it's at the 50-day moving average, I'm going to stick a bid in there. And what happens? Well, we have less sellers because it's coming to the 50-day moving average. People who might have shorted yesterday use that as their price target and they start to cover. So we have less less supply and more demand based on the 50-day moving average. Then you got these people who trade just based on Fibonacci and they say, hey, I shorted as it pulled back after the Fed or the other day when it started breaking down. My goal is to cover some at the 38.2% retracement because I think that's where it's reasonable. And then other people might say, I'm going to buy at the 38.2% retracement. So what I'm trying to build the picture here is that, volume weighted average price from the low and from that peak, we can think of the same exact psychology of this area, which makes this area highly likely to become support.
Yep.
Doesn't mean it will be, but the more people we have believing that it might become there because it's a 38.2% retracement, a 50-day moving average, the volume weighted average price off of the previous low and the previous high, the more people who start thinking this is an important level, I'm going to stop selling, I'm going to start to cover my short, I'm going to start to put some money to work at this so-called value level, that makes it an important level to look at and say, now I want to look at that on a shorter term time frame, like this 15-minute time frame, and see if there is actually evidence of buyers, defending that level. And we don't have that yet, but that's a level of interest that has the potential to become support because all of these people are kind of coming to the same conclusion in the same area.
Yep. I totally understand. I'd follow 100%. Can you zoom out a little bit and throw an anchored VWAP on the October lows, the very, very low?
Yep.
Yeah. And this is what I was looking at too. Watch where this one throws in.
Yeah. And so we had a lot of chop around there.
Yep. A lot of chop around there, but now with it as like almost a target, is it fair to call that like a target underneath current price?
Well, here's the thing too, is, going back to the picture we just painted, what else do we have there? We have the 200-day moving average.
Yep.
And we have a 61.8% retracement.
Yep.
So what if we do come down here and then bounce and then kind of do this and then come down to that level? That to me is reasonable to think that, yeah, that might be a price target. where this might go, but it's not going to be a straight line down.
Because
Maybe
you have too much support in the way from these other important levels.
yeah, potential support, but things don't typically drop that
In a
much.
straight
Doesn't
line.
mean it can't,
Right.
right? But I would be more interested in, okay, I want to start to cover in here and then let it bounce, maybe scalp a little on the long side, but then the next time it starts to roll over right here, similar to what we just saw on the 5-minute chart for the Qs,
Yep.
as it starts to roll over, then I'm going
it.
to get involved on that downside. Where were we? Daily time frame. Sorry. And then set my stop where? Just above this little peak, because if I short there and instead it does this, I can't say the market's wrong. I got to say I'm wrong.
I'm
right
wrong.
here.
Take me out. Right.
Yeah.
Right. Yeah, exactly. I love this. This is amazing. Do you have any references that you could show us where it does not pull back to the VWAP for a very long time, where it's like abnormal, even if it's a stock, not just an indice? Have you ever seen it just run away from an important VWAP and you're like, what is going on?
You can look at some of these broken down names that are, that have kind of just been awful on the downside. So, from this important high in Ring,
Oh my gosh. Never even close to it. No.
I mean, we're at a new low for this stock right now.
Yep.
And you back it up to the weekly time frame.
Oh my God.
Right.
That's got to look like everything you saw in 2001. Those are what the charts are from. Yeah. Like this is what it looks like after 2001.
This
right?
is PayPal, right?
Right.
Wow.
In Pinterest, these things. But
All
then
the
you have
Ps.
the ones that are starting to show maybe there's something going on here, right? So maybe there's something going on with this DT that it's battling with the anchored V. You wouldn't want to buy here because, again, it just rallied from 36 to 46. It settles down. Now the range is tightened up. Now it's maybe getting ready to go on the weekly time frame and enter a new stage 2 uptrend where it does something like this in the coming months.
And now look at your stop on that. Your stop on that is much tighter than it would be if you tried to trade that initial breakout at 46.
Right. So it's moving today. Here's the action today. If you were to get involved, I'd say your worst case stop would go underneath yesterday's low.
Right.
But at the same time, there's been all these other ones. Here's one I had my eye on the other day. I didn't buy it because the earnings were due out. And there's the anchored VWAP from the all-time high.
Oh, wow.
So
look at it right off of that.
I mean, this is not a coincidence, all these touches of it. But I was thinking, here's a stock that's due to report earnings. Maybe this time it's going to get going. Last quarter was right here, and it took off. I was waiting for the stock. I was hoping the stock would do this. And then I was going to buy it right here with a stop there.
Yep.
Instead, it just pulled back, and I never touched it.
Yeah.
Well, then the other day I was looking at it saying, here we go. We're due to report earnings. And if you didn't see that, you might be tempted saying, hey, it looks like a bullish, launch pad.
Little flag here. Yeah. Gap
earnings came out.
Right.
No problem. I don't care. I don't own it. It's too bad because if it had broken higher, it might have gone on to do this in the next, year and go on to maybe go challenge those highs.
Right.
But instead, it's back in there, and now there's no reason to care about it.
I can totally understand why you're so not fundamental for my cocktail talk and you just trade the chart. You know what I mean? Because like I had a week, 2 weeks ago where I was just so fundamentally distracted. I missed really clean trend on SPY. And I feel like that's part of what you're saying, why you don't get distracted with that stuff.
Yeah. So here's Mobileye, which we were talking about earlier. And this was on my radar. I thought, hey, it's, here's the year-to-date anchor. It found buyers at that. It found buyers at the year-to-date anchor over and over again.
Yeah.
And then from this peak, you saw that we had this resistance. It broke that resistance. And I really wanted to own it over here, but I knew the earnings were coming out. And this is the earnings report right here. It got cut by a third.
Yeah.
So, that is, to avoid that is what, if it gapped higher and went 10%, I really don't care. So even right now, that's the anchor, that's the average price from the earnings. So, if something like this happens and it gets stuck under it, well, this is the same thing you see, for instance, on Roku right now. Roku got stuck below the year-to-date anchored VWAP. It had been holding it as buyers right in here over and over again. And then now it's become resistance, and this thing's likely to do something like this, I think.
Yeah. Are you selling that ever on a breakout and retest to the downside, or is that not really your trade?
Short, yeah. Yeah.
Yeah.
I got stopped out of this the other day with a small loss because my stop was too short. A good one that I put on Twitter about a week and a half ago, short, was this one, DOCU. And DOCU kind of had the same look.
Yeah, it looks
Um,
very similar. Break and retest under it of the
so
start of the
here's
year.
that breakdown. There's the anchor from that low. So at that green arrow, that's where it tells me with 100% certainty now, because it's confirmed on a shorter term time frame, that's where I want to short because the sellers have control. The average long from this point where they thought they had the low is losing money. The average short who said, no, this thing's a piece of garbage, we're going to short it now. So it's again back in that downtrend. And you look at the anchor from this high or from this all-time high, it's still a broken piece of
So
garbage.
what does that
And
mean to you when you see this? We would pull back a little bit on this. I mean, this looks like I said, like the 2001 stuff where it just pops and drops and it never comes back. Do you care that DocuSign might not ever go back to all-time highs? No, right? Because if it trades at 30,
no,
20, 10,
no,
you'll still trade
because
it.
I shorted it over
50,
here,
right? You go 55 to 45.
and my stop was here, and I covered some that very first day, I think right here. And then I lowered my stop above these lower highs, and I got stopped out of some there, and then I got stopped out of the balance over here.
Yeah. Is
Okay.
that normally what you're doing, trailing the stop as it moves? Or are you when
Yes,
you are
my
you
stop is always the same on the short. It's
yeah,
above the most recent relevant lower high.
simple structure, just simple
So
structure. Yeah.
as it breaks down here, I set my stop there. As it breaks down here, my stop goes there. As it breaks down here, my stop is there. Breaks
Do you
down, stop gets there. Breaks down, stop goes here.
do you
Out.
take any gains as it falls, or do you just get stopped out on pieces of it and that's where you're out?
Yeah, well, so I enter aggressive, and like I said, I entered here on that first day. I covered a third right here
Take some
just to
off.
reduce my risk in case it does this.
Sure.
I lowered my stop from here to basically just above that 5-day moving average. I always cover some on the breakdown. So as it broke a new low,
Yep.
I always cover some there. And on the flip side, on a breakout, I always get out of some of my long.
Yeah.
And then I use that stop for the final third if I'm able to ride it down to the new low,
That
or if
makes
I'm able
sense.
to ride the long to the new high, then that's where I get stopped out above. I'm sorry, as it breaks below the most recent relevant lower higher low for a
Yeah.
long.
This has been it's so simple. Like, am I wrong? And I know in the book you say simple don't confuse simple for effective is how you said it. And I love that.
Yeah,
This
yeah.
seems so simple, doesn't it?
It does, and I mean all the time. And I'll tell you, I'll show you a great one that I missed because I don't, I can show you some losers too. But this monster is one that
Oh man.
I tried it in here. I think on this move, on this move, I think I tried it again here. I was like, you know what, enough of this thing. I'm done with it. I put it on my banned list, and then it gapped up and pulled back.
Yeah,
Right,
when it
so
came back to that price that you had tried it right there on that last pullback under 53.
well, so here's the thing. Let's take a look. Let's break this move down on a 30-minute time frame. I had so you put the anchor off of that peak right here.
Mhm.
Actually, from the event, that was the earnings right there. So let's
Okay.
just do this. I want to encompass as much of that trade volume as possible. So you can see that we had that first day, then we found resistance again and again. And then over here, that 5-day moving average had flattened out. We had this low, we had a higher low, then it made the higher high. That's where it should have been purchased with a stop right here. And as it broke higher, stop goes here. And as it breaks this high, stop goes to there. And as it breaks this high, stop goes here. And, then as it breaks this high, stop here. Breaks this high, stop. Breaks this high, stop. Breaks, this high, stop here.
Yep.
And look at how, I mean, this is one I missed completely, 100%. And that's how trading goes, right?
That's trading. I mean, you had the right direction. You've been watching it. Just the timing was off by a couple of days. When you look
the weekly chart, I mean, it was building, but it had just chopped me up so many times in here.
Yeah.
That, the third time I bought it, I told myself, well, I'm being persistent, not stubborn. And then the fourth time I said, all right, if I do this again, it's just being stubborn. I got to put this stock on a shelf.
and that's the one that goes.
And that's the law of the market. That's, Murphy's law of the
Yep.
market, right?
Right. Once you stop, it goes. That's it.
Yeah.
Once you stop. Yeah. So now, I mean, this stock in general, Monster Energy, is incredible, isn't it? I mean, since you've been trading it, like if you look at its all-time chart, it's unbelievable. Yeah. It's up multiple 1,000%, isn't it? Yeah.
Yeah.
Unbelievable. Unbelievable.
They adjusted for splits. Where was this thing? I mean, probably a penny.
Yeah. And then, I mean,
a penny.
A penny,
right,
literally 1987. That is crazy. And now look at it. And I mean, same thing on Domino's. Domino's is another one of these food beverage stocks that I'm like, look at that thing. Like look at that thing all time, 0 to 550. Wow. It's crazy.
So what I'm looking for now is what are the next ones, right? So what's possibly next? And, you're not going to buy Domino's now. You look at the weekly chart, it's below all the declining moving averages.
Sure.
But you look at DT, maybe that's going to be one.
Right. But this is where the cocktail talk comes into play, Brian, because now we got to sit around and have a beer, smoke a joint, and talk about what's the new industry we should be looking at. Because you have how many thousands of stocks to play. We got to discourse this and try to get to what is good. Look at all these stocks. How do you know?
Right. So look at Uber, right? And what's important about Uber is it's above all these moving averages. It broke this consolidation. That resistance became support. Yep. And with this earnings report, you put an anchor from the IPO to say what's the average price people are involved in. You put an anchor to the all-time low.
Oh my God, look at that.
All-time high.
Look at that.
Right. So this is clearly, and look, the first test of that, it got rejected hard. Yeah. Now we have an earnings report and it's up through that. The thing is, though, we've just bounced from 29 to 38. I don't want to buy it yet.
Right.
So what I'm going to look for in Uber is something along the lines of this, which is, and who knows if it'll do it, but I'm not going to chase it emotionally. What I want to do is see it do this. And then, that 5-day moving average comes around like this, an anchor off this comes down like this, and then maybe buy it over here, because that's also where we might see, if I put an anchor to this low,
you'll see support.
That anchor might come like this.
Yep, right under
flatten out. Then it gets back above that anchor and above this high. I buy it here, not on the pullback and guess, and not as it's going sideways, but as it makes that first little higher low on the shorter term time frame, and then to set my stop under here, well, then maybe it can go fulfill higher highs and higher lows on the weekly time frame.
Yep. Get back up to 60. And I mean, when you fundamentally talk about it, Uber is a stock where you could look at it, a couple of months out to the year out. Yeah, look at this one. That's another one.
This is Shake Shack, right? They just reported today. And this has the potential maybe of first come. So I put one to this high. I'll put one to this high as well. So this is layering, or the handoff, as I call it in the book.
Yes.
So this is from the all-time high, and that's this one. So that's one. This is from the touch of that. And this is where I think it might get up to this time. So what I'd be looking for is maybe to run up to here and then pull back, find support, and then buy right here with an eye towards a move from the all-time high. Yep. And then doing that on the shorter term basis. So here's today. And then I'll look at, how did it act today from that gap? Yep. Well, we saw that. Do you want to chase that gap? And this is a chapter in the book as well. Chase that gap or wait for it to get back above the VWAP with a stop below the low of the day. And, that's a beautiful trade right there.
Beautiful.
Buy it right here with a stop under there.
I even like the ones this afternoon, 1, 2 o'clock.
Even this afternoon, it broke above it. Then it held a support to buy right here with a stop under there.
Yep. I
mean, there's all kinds of opportunities in these. It's just how close do you want to get, to look at the action. Same is true with, Shopify today, SHOP. And, kind of the same look there. And here's the
look
weekly
at that
chart.
So you're seeing now earnings. Do you find that earnings season sometimes tells us which companies could become the leaders? Like, look at this earnings on some of these companies today. Could that be a sign for the next quarter?
Absolutely, I do. Yeah. And especially when you can look at this and say, this stock made a all-time high in 2021.
Yeah.
And it went through its bear market. It scared people out. And then over the last year, it wore people out. And now we've got a rising 10, 20, 30, 40-week moving average.
Yep.
We got rejected at that anchor from the all-time high on this run. It built some energy. Now it's breaking out. on earnings. I didn't look. I don't know what the earnings are. I really don't care. What I
Right.
know is that a lot of growth managers are looking at this and voting with their pocketbooks today, saying this was significant. We need to own it. And here it's broken beyond the high of this stage one accumulation. I drew that wrong. It's broken above that high. I drew it wrong again. So here,
Yes.
this was support turned
Yep.
resistance.
Yep.
That resistance was further made clear with that anchor from the all-time high. Now we know the average, the dollar cost averager all the way down, they're making money. The average short seller, not the short sellers down, and the short sellers down in here, it's even worse, right? We know they're all in a losing position. Anyone below this line, anyone who shorted in the last year, basically, is losing money.
Yep.
The average long is now making money. So the path of least resistance is higher. Here's a great chart that, I think, traditional technical analysis, maybe it does this, runs up to this level, maybe a little shakeout, and then it runs up to the next level on the chart, up towards this area. So, those are maybe the next winners. Or maybe Shopify is going to restate their earnings tomorrow and it's going to open at $30 per share.
Revised earnings, right. Uber revises and says, actually, no one's using the app. We lied. We need to cut it back. We're a $13 stock, not a 40. This has been awesome, Brian. This is very, very insightful. I know we're over time, so we can wrap it here. I really, really appreciate this. Let me stop our screen share here.
I've just got a quick question whilst
Yes.
we're still on for some of the listeners. So a lot of so with this being price, volume, and time, this can be applied to any chart, not just stock. So this, do you know, are people using this successfully in like Forex, on commodities, things like that as well? Same principles
I put one
apply.
on there yesterday about on oil, crude oil. Anything that has price, volume, and time, it's applicable to. I don't trade Forex, so I can't tell you directly. But I've told people, had people tell me I trade Forex, but Bitcoin, it's absolutely fantastic with Bitcoin.
That's all I needed to hear.
And Ethereum and some of the other ones as well. I mean, it really trades well because, especially where you arguably don't have fundamentals, not in the traditional sense. It's more emotionally driven and it's crowd behavior. And where is that collective psychology associated with price? And that's where we tend to see the movements, congregate.
Yeah, that makes sense.
Love that. Brian,
how long has it taken you to master this? I know you've been trading 30 years. Last question. I could ask.
He's going to say he's not a master of it. That's what he's going to say, right, Brian? He's going to be like, I am the guy with the book, but I'm not the master.
I mean, shit, I make mistakes every day. So I don't know what mastery means. Consistency is what I look for in consistently making less mistakes than I do good decisions, because I know I'm going to make, bad decisions here and there, or the market's going to disagree with me. To me, it's more about, the way I judge my day isn't necessarily P&L, but everyone loves getting a big P&L day, but it's more about, did I do the right things today? That's what I want to know, because in the end, if I'm doing the right things, the profits don't take care of themselves. I don't like that. But if I'm doing the right things, it means I'm cutting losses and I'm, managing risk and taking gains, that things should work out.
So how long have you been using the anchored VWAP in your process? Like, we hear people jumping from one thing to another. How many years have you been using this?
I first encountered it in 2003 on a trading platform called RealTick. It wasn't point and click like this. Point and click came on TC2000 in 2015. They called it the anchored VWAP by Alpha Trends because I requested it, and they said, Brian, we want you to use our charts. I said, okay, if you can build this, and like within 2 weeks they did. So really, my use of it has expanded exponentially since 2015.
So it's still good 8 years of using it every day.
Every single day on pretty much every chart. I'm always clicking a VWAP here or there.
I love that. Love it. Brian, it's been a pleasure. It's really good to meet you and speak with you for the first time and have you on the show. I'm sure the listeners really enjoyed this. For everybody listening, make sure if you just listened, you got to go back to YouTube or Spotify and rewatch the episode so you can see the charts that we shared. Brian, where can we direct everybody to connect with you? Twitter?
Yeah, Twitter's best. I mean, anything I put out for free is on Twitter. So, you don't have to go to my YouTube channel. I'll put my YouTube on Twitter and anything else. So that's where to go, Twitter.
Twitter for Brian, Amazon for the book.
Yeah, at Alpha Trends, ALPHATRENDS.
Perfect. Beautiful. Brian, thank you again. Listeners, we appreciate you. Tom, thank you for being
Thanks,
engaging
Tom.
today.
Thank you, Austin.
Yeah,
Nice to meet
been
you.
a pleasure. See you guys in the next episode. Thanks, everybody.